For more on this, let's bring in Tim Waterer. He's Chief Market Analyst at KCM Trade. Good to see you, Tim. Now, Asian indices saw historic gains over the last 3 months thanks to the rise in demand for AI-related stocks, but we've now got an extended sell-off. Is this more than just a correction?
Nice to be with you. At the moment, I'm viewing it as a healthy correction at this point, nothing more at this stage. But having said that, there are a combination of factors working against the tech sector right now. And I think top of the list is probably profit taking. When you look at the big decliners on the South Korean market today, they were the chip manufacturers SK Hynix, which even after today's slide is still up over 200% for the year. And Samsung Electronics was the other one, which is up over 100% year to date. So I think those lofty gains we've had so far this year, tied in with a little bit of uncertainty around the interest rate picture, that's prompting some of the profit taking that we've seen, which has been focused on those semiconductor names. And we saw a bit of a similar story in the NASDAQ in the previous session. So I mentioned the interest rate outlook. That's a bit of a concern for investors right now. Yes, oil prices are lower, but we could still have a lasting legacy of inflation. And Kevin Warsh, what we've heard, is still staying on the front foot regarding fighting inflation. So that's keeping the prospect of higher US rates on the table later this year, and perhaps for a number of other economies around the globe as well. So, but look, having said all of that, I think that it is interesting that the chip makers are the ones under the most pressure, because I think they're probably the ones, in terms of the AI space, looking the best right now, given that it is a supply shortage story regarding memory chips right now.
Now, with Fed Chair Kevin Warsh calming market speculation over a rate hike, will this spark a broader upward trend for gold, which has declined by around 14% over the past quarter?
That's right. Gold got off to a rocket start to the year, hitting record highs in Q1. But then really the onset of the US-Iran conflict, that drove oil prices higher, drove the dollar higher with it. And that hurt gold from a yield perspective, with that pivot from the Fed now expecting rate hikes this year rather than rate cuts, which is what we thought entering 2026. So gold, I think there's been a bit of value hunting really, which has really boosted it around these $4,000 price levels right now. So I think that bargain hunting has provided a little bit of a base for gold. The problem for it right now is that, yes, oil has come lower, that helps it, but the US dollar, that's still quite elevated. If we look at where the dollar index is, it's still trading above like 100, 101 right now. So that's still a headwind for gold. Could it come into favour once again if, as an inflation hedge, for example? Possibly. But right now, I think we'll probably need to see a lower US dollar for gold to get a little bit more traction on the upside than what we've seen so far.
And with oil prices falling, with Brent at around $70 now, how much of this relief will impact corporate margins this coming quarter?
Yeah, I think it's certainly a positive development once you have a high cost component, which is a high oil prices, being removed to a large extent. We've seen a big decrease over the past quarter, which you've mentioned. So yes, I think that certainly does help the corporate sector from a profitability standpoint, as well as the general public at large in terms of the prices they're paying on the supermarket shelves. So I think that helps from a demand perspective as well, if we look at the retail sector, if we have these lower oil prices right now. So yes, I think we could see that start to basically play out in terms of the earnings figures that we do see in coming quarters. Having said that, that is sort of predicated on oil prices staying where they are right now, which is no guarantee. So oil right now very much priced for normalisation to occur in the short term around the Strait of Hormuz. It hasn't happened yet. Yes, there's been some improvements, but we're still well short of the traffic numbers we saw pre-war. So I think any further delays or any further hiccups in US-Iran relations, oil could be heading higher once again, and that could put a dampener on company profits moving forward.
And if flows through the Strait of Hormuz do continue to weaken oil prices, would OPEC need to step in to prevent prices from falling further?
They could do. There's been a little bit of reluctance for them to do that, I guess, even before the conflict began. A lot of the market was expecting OPEC to be a little bit more, aggressive in terms of their output cuts to try and counter the weak prices we saw before the conflict, but they were more focused on market share. That seemed to be the driving force for them. So I think the sweet spot in terms of profitability, it varies a little bit between different nations, but I would say is generally sort of in that $60 to $75 bracket. That's roughly where we're sitting right now. So I don't think OPEC will be too worried about prices where they are currently. But look, if it fell sort of in the low $50, for example, then I think that could be a different story, and we could see further supply cuts to try and balance out the equation a little bit more in terms of that supply-demand picture.
Tim Waterer in Sydney, great to speak to you as always. Thank you.